Hi everybody, this is Phil Holoka from Complete Captive Management Services. Today we conclude our three-part series on captive financial statements with a conversation about ratios, my favorite topic. So, we're going to talk about the fronted captive arrangement. And the reason we're going to talk about the fronted group captive is much in the same lens as when an investor wants to compare multiple stocks. The reason is the investor wants to give $1 and they want to have that underlying investment return a profit. That's what ratios do for this. It cuts through the glitz and glamour of captive promoters and captive programs. It allows the investor to understand with clarity, if I invest $1, what's my anticipated return? That's what we're going to talk about today. Now, we don't talk about the direct writer captive because those financial statements are much easier and don't involve many of these calculations. However, a direct writer captive is generally a single parent captive. So unless that single parent captive participates in a risk pool, you're not going to find many of these. So the insured, the employer, is investing in a group captive. They need ratios. So we're going to talk about those today. So let's dive in. Okay. The number one thing you need to look for is the fronting fees, administration fees, and quota share. Fronting and administrative fees are generally expressed as a percentage of the gross written premium, and the quota share is generally expressed as a 100-0% or 90-10%, meaning if it's a 90-10 quota share, the captive retains 90%, the fronting carrier will retain 10%. So, these have costs to them. The arrangement and the costs will be expressed in the reinsurance agreement. Got to get your hands on that. The excess attachment point is expressed generally as a floating layer above the individual stop-loss policy's specific deductible. That could be $200,000, $250,000, $300,000, and the excess attachment point has a premium associated with it. So you're going to want to find out what the attachment point is and what the premium is, and that too will be expressed in the reinsurance agreement. Because, remember, the excess carrier is probably also the fronting carrier. Okay? Now, miscellaneous underwriting, marketing, those other fees may be mixed into the fronting fee and administrative fee, or it could be its own line item. So all of these fees are expressed in the bordereau report. It's so important to get your hands on the bordereau report because that's where all the secrets are, the expenses of the fronting carrier. So, the employers pay $1 million of gross premium. 1, 2, and 3 total a $300,000 expense. That leaves net written premium of $700,000. That $700,000 is called the working layer. That's the amount of cash the captive has control of to pay claims. Okay? Now, fronting carrier load is a ratio of you collected $1 million, you have $300,000 of expenses, which means your fronting carrier expense load is 30%. For every dollar collected or paid by the insured, the fronting carrier is keeping 30 cents, 30%. Okay? Is that good? Is that bad? Well, you got to compare and understand. If it's a high quota share, that might not be bad. If it's a low quota share, that might be too high. So you just have to compare and contrast. Okay? premium growth within my world, captive insurance. If a captive isn't growing, it's not doing very well. So therefore, if you're going to invest in a captive, it's got to have an increase in premium year over year. So where do you discover that? The profit and loss. Well, now wait a minute. I said the important values of a captive are generally on the balance sheet. Yes, that's true, but the ratios are found on the P&L. Okay, so you get your hands on the P&L. You want to see the end of the year P&L, and you want to see it in comparative view, meaning year over year, 2021, 2022, 2020, 2021. You want to compare the two rows, or the two columns, okay? So premium growth calculation is current year premium minus prior year's premium divided by prior years. So in other words, 700,000, let's assume for a minute that you collected 500,000 last year. There's your calculation. But wait a minute, you've got to back out medical trend because last year's premium of 500,000, medical trend just inflates that for no reason. So you got to back that out to get a pure side-by-side comparison. So let's assume medical trend is 10%. Therefore, we've got to multiply the current year premium by 0.9. That gives you 630,000. This is a comparative side-by-side reflection of premium growth. So 630,000 minus 500,000 divided by 500,000 equals 26% premium growth. Is that good? Probably. If this number is 300%, is that good? Probably. If this number is negative, that's probably not good. Okay? So you want to make sure that the captive that you're investing in has a positive premium growth. Okay? Loss ratio. Does the captive have enough cash to pay the claims? This is a solvency question. Okay? Again, profit and loss will disclose the values that you're going to need to calculate. And ideally, you're going to want to look at Q4 or Q1 of the following year because claims generally develop later in the policy year or the treaty year. Okay? So, to calculate the claims loss ratio, current year losses divided by net premium for the current year. So let's assume that there are 500,000 of losses. There is $700,000 of available money, leaving a 71% loss ratio. Is that good? Yeah, that's good. If this number is higher, 90, 95, 100 plus, that's not good. If this number is lower, the lower the better. Okay? Now, if you want to calculate last year's loss ratio, it's the same thing. Prior year losses divided by net premium of prior years. So, you can get this loss ratio calculation with either current or last year's. Okay? Captive fixed expenses, often overlooked, also very important. SG&A, sales, general, and administrative costs. Those SG&A expenses are generally captive management fees, service provider fees, actuary, legal counsel, the audit, the investment fund. Those are all expenses that make the captive work from service providers, as well as domicile tax. Domicile tax and state premium tax? Two taxes? Well, yes, there is. Each domicile charges a premium tax or some sort of cost to do business in their domicile. You got to lump that in with the captive fixed expenses. and we'll talk about this in a future video. And then meeting and T&E expenses, travel and entertainment. You got to lump all of these expenses together, and those will be listed generally in the statement of operations within the financial statements. So let's assume that $80,000 is the total SG&A expense of the captive. You divide that by the premiums collected, the net premium, and you get 11% expense load of fixed expenses. Is that good? Probably. The higher this number, the worse it is. The lower the number, the better. Okay? But we're not done yet. You got to take your fixed expenses. You've got to add in your variable losses, your claims. You get 82%. So if you take 1 minus 82%, that leaves your captive's profitability, 18%. It's still not over. We haven't talked about the member's investment yet. To get the return on investment, you've got to take the fronting fee load, add in the captive expense load, and you get a value. In this example, 112%. So what does that mean? Well, that means the member is probably going to pay 112% of the market rate, which is not good. You're overpaying by 12%. However, that's going to yield an 18% captive profit. So in other words, is the insured willing to invest 112% of the market premiums to get an 18% profit? The net is 6%. Probably. But if this number's 120 to get an 18% low or profit, that is no go. If this number's lower, the return of profit is even higher. So it's very important to understand the fixed expenses. This one and this one. Claims expense, that's also very important, but it's not as important as understanding where efficiencies can be had. 71% is still a pretty attractive loss ratio. Okay? Now, lastly, 18% captive profit does not translate into 18% member profit. Okay? 18% is what the captive made. Allocation to the members of those underwriting profits is an entirely different story. And we're going to talk about that in a future session, future video. So until then, very important topic. Lots going on here. We're here to help if you have any questions. We'll see you next week. Bye now.